What a crazy day for the market. Big developments, unforeseen market moves, and it all stemmed from CPI. Inflation came in cooler than expected, but the market got punched in the gut after less than dovish interest rate projections saw markets come off their highs intraday. FOMC participants are now only expecting 2 cuts instead of 3 cuts for the rest of 2024, and longer run projections are looking a little less dovish. But with CPI and FOMC now in the rear view, what exactly does this mean for stocks looking ahead? And is now the time to get even more bullish at all-time highs? Today, we're going to talk about that, as well as give you a macro overview of the economy, where we currently stand and where we're going. There are some good charts and there are some concerning indicators. Along with that, we're also going to talk about earnings, value versus growth, and of course, seasonality. Where do we go from here? Is this the end? Join us today as we talk about stocks and the financial markets. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Now, what a day for the market here. US stocks popped to fresh new all-time record highs on Wednesday as the market digested 2 things. Number 1, cooler than expected inflation. That was the first. And the second, the Federal Reserve holding rates steady, but actually slashing projections for cuts this year. And this left the market in a very bifurcated state, but it was definitely risk on sentiment for the most part. Look at defensive sectors, right? Telecom services, consumer defensive, so pretty much staples, and then like most of healthcare, as well as utilities. These defensive names all took it on the chin. Energy as well, I wouldn't call it a defensive sector, but they are a value play of sorts, and people do rotate to them in a risk-off environment. So, the sectors that normally rally in a risk-off environment didn't do too well today. It was definitely risk-on, led by technology, semiconductors, Nvidia, Apple, Google. Apple actually up 2.86%. Now the number 1 biggest stock in the world, actually overtaking Microsoft, which was actually up another 1.94% here today. So technology doing very, very good. Credit services and financials didn't do too well, but the rest of financials did pretty good. Asset management, capital markets, regional banks, very, very green here today. And it was risk on across the board. The S&P 500 returned 0.82%, with the best performing sector being ITB. And it was really like rate sensitive sectors, cyclical sectors at the top. Look at semis, home construction, regional banks, software, technology, discretionary, industrials. Really just like if it was risk on today, it rallied. And we also saw stuff like home construction up very close to 6% here in the pre-market, but then actually coming off its highs. And there's a couple of reasons for it. So right here, right before pre-market, we got the CPI numbers. The CPI numbers came in cool. Month over month headline CPI was at 0%, year over year 3.3% against the market's expectation of 0.1 and 3.4%. Then we actually look at the core components, so excluding food and energy, month over month 0.2%, year over year 3.4%. That was what was reported against the consensus of 0.3 and 3.5%. So very cool CPI numbers. And this is why most stocks actually just gapped up in a very big way, 1, 2, 3%. You can see here in home builders up 6%. Yes, it did come off a bit. You do know a bit of profit taking, but what we really saw was stocks really just traded sideways after the huge gap up until this 2 p.m. mark. Then we got the interest rate projections right here, and then markets actually came off their highs quite significantly, especially those sectors that sort of traded up and sideways into the actual press conference. And that was because of interest rate projections. Previously, we were expecting 3 cuts. That was the projection. Now FOMC participants were actually predicting 2 cuts through 2024, which the market already knew. The 10-year was already priced to do that. But when we get confirmation from the FOMC, I guess it's stated that we now have to readjust our targets too. So 2 cuts instead of 3 cuts. Still overall bullish. That's why the market was still in risk on fever, but we did pull back from the highs on this news right here. And I think part of the reason why we actually got a pullback from the highs was some of the comments that Powell made. I think people were expecting him to come out incredibly dovish after those CPI numbers. He held rates steady, but he kind of came out neutral, said the same old thing. We won't cut rates until we are confident that inflation is moving sustainably to our 2% target, and or if there's unexpected weakening of the labor market. He said the exact same thing that he always has, whereas I think the market was expecting a slightly more dovish tilt, and when his tilt wasn't that dovish, they took it as slightly hawkish, and that's why we pulled back a little bit from those highs. But you shouldn't really be concerned about it at all, because S&P 500 returns post-Fed decisions, especially in the last 5 or 6 decisions, have been very, very bullish. Look at the 10-day returns here in November, 6.6%, here in December 1.8%, here in January 2.5%, and in March negative 1.2%. Average return across the board right here sitting at 2.9% return, and if we actually include May's decision 4% 4.3% 10-day return right here. So very, very bullish. So generally speaking, and any weakness we do get, you do want to buy the dips. But let's actually hop on the charts and talk about our expectation for the S&P 500. Looking at the overall market here today, the S&P 500 hitting a new high at 54.21. Nasdaq 100 also notched a new all-time closing high, very close to 19,500. The IWM up 1.5% year today, but starkly off the highs. Very similar price action in the RSP, but up 0.54%. Mid-caps up 1.3% today. S&P 600 up 1.65%. The 10-year yield actually fell and closed at the 4.3% level. Bonds firmed up. Gold was little changed, up 0.36%. Silver was up 1.45%. Dollar fell significantly, and crude was up 0.77% for the day. So all in all, it was actually very risk on today. You can actually see that equities gained, rates fell, and commodities were actually sort of upbeat today. But what we do have to take into consideration is that a lot of equities actually made highs and then came off their highs, particularly in the small caps and mid cap section. I mean, you know, the S&P 500 and the Nasdaq still did leave quite a bit of a gap here, but we are approaching overbought territory in the RSI. That's a bit concerning, and we do have to look at everything in aggregate. Our gamma flip zone as well as the put support zone is here at 5,300. So this is the support zone. We're a while off this 5,300 area. Also, the call gamma resistance is at 5,400, right? We're currently at 5,421, and that pretty much tells us unless the gamma flip zone moves to the 5,500 area, right now what we're going to do is either trade sideways or down. Risk right now is to the downside. When we were here at 5,300, risk was to the upside. When we were here at 5,250, risk was to the upside. When we were here at 5,000, risk was to the upside to the 5,400 strike. We're at the 5,400 strike. In fact, we're above it. Don't be surprised if we do see some downward momentum unless we actually get the gamma flip zone to move to 5,500. So I am agnostic. I do think we're probably just going to trade in a range into the June OPEX over the next week unless we actually see a lot of traders roll up the strikes to the 5,500. But I think they're only going to do that after June, give themselves a bit of breathing room and just take a bit of profits. That's normally what we see. So my take right here is probably we trade down to as low as the 5,300 over the next week and a half. If anything, we probably go sideways unless the gamma flip moves to 5,500. Now looking at gamma, nothing has changed from yesterday. We are still seeing a ton of positive gamma, not a lot of negative gamma, and some of this compression, I guess you could call it options compression, gamma compression, or volatility compression. You can see the gamma flip zone and put support at the 5,300 moving up while the 5,400 call resistance is staying where it is. And that just means volatility is being compressed while there's still a ton of positive gamma here in the tape. Now I am recording this pre-market, and pretty much when you see this type of stuff, when you see volatility compression in the tape like this, it leads to a big move, a big squeeze either to the upside or the downside. So I do think that if we break this like 5,400 or 5,300, we're going to see a massive move. I'm talking like 50 to 100 points in a single day to the upside or the downside here, regardless of what the CPI does in the next week. I think once a lot of this gamma rolls off, a lot of the volatility compression is going to be dissolved, and then we're really going to see the market move in the window of weakness. That's what I'm betting here. But the same rules apply. Buy dips, sell rips at the 5,300 to 5,400. Below the 5,300 area, I will be a seller, but it will be a very strong support zone. So you guys know the go, you guys know the play. It's all right there. 5,300 is the key zone right now. Now, FOMC wasn't the only big thing we got today. We also had earnings here on Wednesday, and we had a big player report earnings here, AVGO, and it was very good earnings from Broadcom. It was a double beat. They beat on EPS. They reported $10.96 against the street's expectation of $10.80 on sales of $12.49 billion against $12.6 billion. They also actually raised full year guidance to $51 billion from $50.58 billion and announced a 10-for-1 stock split, because that's a hefty stock price right there. They're going to be going to about the 150 level, maybe 160 after the bullish momentum they saw here in the after hours. The stock was up 12.54% on this earnings, and it actually provided a lift to a lot of the tech names, semi names, the S&P 500 as a whole. We did see a bit of a jump after Broadcom released these earnings. Very good earnings, and I do think we should probably pull back a little bit here in Broadcom and then continue to move higher into next quarter's earnings. So very good earnings here from Broadcom. Semiconductors still on fire, still the best momentum and earnings sector to be in for 2024, and likely will be for 2025 and 2026. So we got some very interesting data here from both with just regards to stocks, value, and growth. We're just going to go over a couple of charts they gave us. So they say 65% of all US stocks are growth and allocations near record highs. So pretty much in the S&P 500, 325 of those stocks will be growth orientated stocks. stocks, which is actually a lot. And you can see that this is actually approaching highs we last saw here at the dot-com bubble and the Great Society here in the 1960s, 1970s. Now, growth has actually outperformed value ever since the GFC. Pretty much when we've been in this zero interest rate environment, growth has actually starkly outperformed value. You can actually see here that before the GFC actually happened, value outperformed growth on average by 4.9% every single year. And this is the 10-year rolling annualized returns. But BofA do expect that to change. They can actually say that value will retake the lead in a 5% world. They forecast that value will outperform growth here in 2025, and that will actually continue. This is US value versus growth, 10-year annualized returns versus the macro indicator. And pretty much below this line, growth wins, above value wins, and we should see value outperform growth from 2025 onward into 2035. Do I think that's going to happen? I'm not too sure. This is why I generally always invest in stocks that are reasonably priced. I look for growth at a reasonable price, and I think the intersection between the two will probably provide the best risk-adjusted returns. Now, part of the reason why growth stocks have actually outperformed value stocks is simply because a lot of growth stocks have grown very profitably over the last couple of years. We can see here that free cash flow as a percentage of sales has actually increased quite significantly. And again, this is due to the growth complex. You can also see here that this sort of started here in 1995, early 2000s, after the tech bubble, when companies really became fixated on profitability and not growth at all costs. And that percentage right now sits at 11.4%, which is actually kind of crazy. So pretty much if a company makes $100 billion, $11 billion of it will be free cash flow for investors that can be used for dividends, share buybacks, mergers and acquisitions, pay down debt, any type of shareholder value creation. And that's part of the reason why stocks have done very, very well in the last 10 to 20 years. And the simple fact that companies are just so profitable right now is also why S&P 500 companies have remained so resilient in the face of higher rates. So you can actually see that interest expense used to be very, very high here in 2003, 2007, as well as 95 to 99 in this period. And interest expense has come down. And even though the 10-year yield rate has normalized to its long-term average, S&P 500 index components interest expense as a percentage of total debt is actually still at largely historically low levels. Now it is increasing, and that is obviously due to the Fed's hiking cycle they embarked on in 2022, 2021. But most companies are still paying about 4% on their debt for the most part, and a lot of S&P 500 companies, particularly the big companies that move the market, are paying a lot lower rate than that because they got long-term fixed rate debt when rates were anywhere from 1 to 2%, 2 to 3%. But we are getting rate cuts, and it does look like this is probably the peak for rates for now. We do know the Fed want to cut rates, and we should see this decrease into 2025, 26, 27, and so on. Now let's look at index composition. Now this is something that was very interesting. Now this is the largest individual contributors to annual S&P 500 performance. So right now, the S&P 500 has returned 12.4%. Of that 12.4%, 35% has been growth from Nvidia because it's increased 145% year to date. So this is actually really concerning for fund managers because if they don't have Nvidia in their portfolio, if they're not allocated to Nvidia, they're probably largely underperforming the index because so much of this index return has actually been from Nvidia. Now looking at 2003, you can see that Microsoft actually returned 13% of the index's return, and we returned 24.2% last year. In 2022, it was actually ExxonMobil, but the S&P 500 was down 19.4%. It gained 2.8%. In 2021, in the everything bubble, it was actually Microsoft. 10% of the index returns came from Microsoft. The S&P 500 returned 26.9%. And then in 2020, it was Apple returning 22.4% of the index's returns, 16.3% return in that period. So very, very interesting to see tech and energy at the top of the heap. And that's part of the reason why my portfolios, the undervalued portfolio and the top picks portfolio, have done really, really well, because I actually hold Nvidia in those portfolios. So in light of CPI, let's look at the economy as a whole from a bird's eye view, from a macro perspective, look at everything. Now, firstly, let's start with GDP growth. Ultimately, this is what everybody looks at, and GDP growth has been pretty solid here. If we look at the last 4 quarters, we can see GDP growth of 2.1%, 4.9%, 3.4%, coming in a little bit weak here at 1.3%. Now, the expectation for this quarter was 1.6%. There was a couple of adjustments with net exports and inventories that did affect this number in a very big way. If you strip them out, GDP was actually at 2.8%. That being said, we do have to look at this number in aggregate, sitting at 1.3%. But things are looking up for the second quarter because the Fed's GDP now is sitting at 3.1%. We've seen the Fed's GDP now move up in a very big way from the 1.8% level just a few weeks ago. AVGO, we're now sitting at 3.1%, well above the blue chip consensus, and this is for the second quarter of 2024. So GDP looking very healthy. It's been very healthy in the last 4 quarters, and it's looking to continue. Now, part of the reason why we've actually seen very big GDP numbers actually has to do with the jobs market. Now, non-farm payrolls, which just measures the change in the number of people employed during the previous month, excluding the farming industry, has come in very, very hot. Last week's print came in at 272K. We forecasted 182K. The previous was 165. And this isn't an outlier month. This has been the case for most of 2024. You can see that January's numbers, 216K. The forecast was 170K. And these are the revised figures, by the way. February's came in at 353K. The forecast was 187K. March was 275K. The forecast was 198K. April's figures was 303,000. The forecast was 212K. May was the only outlier figure where the actual was below the forecast by quite a significant amount. 175 was reported, 238K was expected, and then this was last week's number, 272 versus 182. So the US economy has been adding jobs at a rapid pace, well above the forecast growth, and that's obviously very good for the average person because they have jobs. If they leave their jobs, they can find jobs. And if they come over to America, they're definitely seeing employment opportunities come their way. But while we are seeing huge jobs growth, aggregate income growth is strong, but it's not running red hot like it was here in 2021. Currently, aggregate income growth is sitting at 6%, and if we actually look at disposable income growth and employee compensation growth, currently sitting at 4.1% and 5.7% on a 1-year annualized basis. And if we compare that against PCE inflation of 2.7%, you can actually see that employee compensation as well as aggregate income growth is running well above the Fed's preferred gauge of inflation. And with a higher disposable income, this means families are in a better position with regards to debt. Household debt service, although it has come up since the 2020 lows right here, this is literally just a normalization of the household debt service ratio, and debt payments as a percentage of disposable income is sitting at historically low levels. I mean, even if we look at the pre-COVID era right here, debt payments as a percentage of disposable income was actually low, but we are currently sitting at even lower levels than that. And even as we normalize, we can start to see that we're sort of normalizing at this level right here, which is very, very healthy. And that's as a result because disposable income growth is very, very strong right now. And again, if you compare this to history, debt payments as a percentage of disposable income is sitting at historically low levels. The consumer is in a very strong position. At the same time, they also have a ton of excess savings to draw on. Now, it's definitely not the peak we saw here of 2.3 trillion in 2021, 2022. However, the average consumer is sitting on 800 billion worth of excess savings. However, personal savings have deteriorated, but the truth is these are excess savings. Once this runs out, consumers will start putting money into their personal savings. So consumers are sitting on a ton of excess savings. We do know that a ton of money is in money market funds above $6.6 trillion. The consumers have a ton of assets to draw on. And in light of all of this data, both have actually outlined a couple of predictions with regards to the economy. Now, I'm not going to go over every single thing right here, but they say implications under each of the scenarios for Fed policy, rate ranges, curve dynamics, volatility, along with the current market implied likelihood. Now we can see a soft landing, which both are defined as growth between 0 to 2% and a 2% inflation target. They see that as a 45% likelihood. They see a no landing as a 30 to 35% likelihood. And then the other two outlier scenarios, reacceleration of either growth or inflation, they see that as a 5 to 10% likelihood of occurring. And then a hard landing, they see that as a 10 to 15% chance. So pretty much right here, you're looking at a 15 to 25% chance of a hard landing or reacceleration in inflation or growth. In other words, hyperinflation or stagflation. But these two right here, soft landing, no landing, it's probably the highest likely outcome, anywhere from 70 to 90% odds of this happening. So you do want to position yourself for the most likely scenario, because when it comes to the macro, when it comes to the economy, the most likely scenario is probably the outcome that's going to occur. Why? Because that's what people want. That's what CEOs want. That's what the consumer want. That's what politicians want. And everybody works towards that. So you want to position your portfolios for a soft landing, no landing. And in both those instances, you're definitely going to see rate cuts, because in both these scenarios right here, soft landing, no landing, it's bullish from a policy standpoint. You can actually see the Fed's policy in a no landing scenario is actually higher for longer, but that doesn't mean any rate hikes. Hikes are only priced in here at the reacceleration phase. So pretty much we're just going to remain at the current policy rate higher for longer. And that means a 5 to 5.5 0.25 Fed policy, and in a soft landing scenario, you're going to get 1 cut per quarter. But in all, no landing, soft landing, you're definitely going to get cuts eventually, and that's how you want to position your portfolio. And what does that mean? It means you want to hold equities, it means you want to also hold a bit of bonds, and you do want to hold a bit of commodities. So have a diversified portfolio across stocks, commodities, and bonds. So what exactly would exposure look like to that portfolio? Well, I gone ahead and just created something here. Now, this is just something I created on the fly. I call it the Chasing Alpha Diversified Portfolio, and it just consists of 10% commodities, 20% bonds, and then the rest in ETFs or equities. And the exposure you have here is value to the US and internationally. You have a small cap quality ETF, you have exposure to real estate, and then large cap US stocks right here, which is just the momentum factor ETF. You also then have exposure to 3 to 7 year treasury bonds, so sort of in the belly of the curve, and then just a commodity index. You can actually replace this 10% with gold as well. You could do 5% GSG, GLD, could do Bitcoin. I just did the iShares commodity index just to get broad exposure to commodities as a whole. And this is what the portfolio looks like. Essentially, if you really wanted to, you could just take all of these stocks, and instead of having 8 portfolios, you could just put it in VTI if you really wanted to, which will just give you broad market exposure, or VT if you want the total stock market index across the globe. It's really up to you. This is fairly diversified between the US, values, small caps. We have real estate exposure right here, and you do also have exposure internationally. Now, the returns for this portfolio are actually quite robust, not quite as good as the S&P 500, but you can see the max amount we have here is 42 years worth of data. In that time, 10.91% compounded annual returns. In the 30-year period, 9.08%. In the last 10 years, 6.68%. In the last 5 years, 7.9%. So it has actually underperformed the market as a whole in the last 5 years, simply because you have quite a lot of exposure here to small caps as well as value stocks, and we do know that growth as a whole has outperformed for the most part, and I think commodities have actually underperformed. So if you did replace this with something like gold, you would see better risk-adjusted returns, but this is sort of like a buy and hold. You sort of buy this portfolio every single week. It's just ETFs, so I'm trying to capture as much alpha in a broad range of macro environments. I'm talking recessions, boom bust cycles, everything, and I think this is what will perform the best. In the last year, however, the portfolio has returned 20.11%. In the last 6 months, 12.68%. In the last month, 3.49%. And here is the portfolio's return since January 1995. $1 would have returned on a nominal basis probably close to $14, maybe $15. So it's a 15x return for this portfolio. And this right here is the inflation adjusted returns. So very good returns in aggregate. So if you guys are looking for a portfolio with great risk adjusted returns, I would definitely look at something like this. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.